800-430-8804. 800-430-8804. Again, that's 800-430-8804.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about the use of life estates and your primary residence. Todd, what are the pitfalls associated with creating a life estate when you transfer the remainder interest to your children?
Yeah, this is the most common way people create life estates. It seems easy, it seems simple, but it's not the best way to create a life estate. Once you put your children's name on the deed, you give up a lot of control. Like you can't change your mind later if you want to leave it to one child versus another who might be taking care of you later. You have problems if you want to go to sell it, right? You might have the right to live there, but if you want to go to sell it, you're going to need the permission of the children in order to sign off on the remainder interest of the deed. And then even if they do sell it and you get their permission, a larger chunk of the proceeds are going to end up in the hands of the child rather than you. That creates adverse income tax consequences to the child, plus you, who sold the house, might need the money to buy another house or a downsized house or move, all of which create problems. Never mind creditor problems for the children while they're living. Folks, don't do the life estate this way because it seems to create more trouble than it's worth.
Learn how you can avoid probate, eliminate estate taxes, keep your money in your family, and protect your assets from the nursing home. Request this brand new guide from Cushing & Dolan. It's called Calculating the Consequences of a Life Estate. Call 866-848-5699. That's 866-848-5699. Or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Is there anything better than sitting on a beautiful beach, watching the sunset with an ice-cold drink? You can experience that right now by booking your next vacation to the United States Virgin Islands. St. Croix, St. Thomas, and St. John are all unique in their own special way. And if you head to usvi.com, you can create the vacation of a lifetime. Whether it's the rich history of St. Croix, the pristine beaches of St. Thomas, or the spectacular nature of St. John, the USVI has a little bit of everything for today's traveler. Upon arrival, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to usvi.com. Whether it's a romantic getaway or a family vacation, the U.S. Virgin Islands has everything you need to enjoy. The vacation of paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Paul Lane and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Paul Lane and Marc Fandetti.
Welcome to this Tuesday edition of the Financial Exchange. Paul Lane, Marc Fandetti, and Tucker Silva here with you. Taking a look at markets early on in trading, we've got the Dow Jones off about 100 points, the S&P 500 off close to 0.5%, and the NASDAQ off over 1% as Apple shares are taking a bit of a hit today. We'll get into that as the show progresses. A little bit of a lull in terms of economic data. However, we will have the jobs report coming out on Friday. Chairman Jerome Jerome Powell will give his testimony tomorrow, and there are still earnings reports that we'll be digesting during today's show. But we'll start the show with a little bit of commentary on U.S. consumer debt as it relates to their debt from a mortgage perspective and a non-mortgage perspective. There's this piece here in Bloomberg by Ben Hallen, which is titled, "Americans Now Pay as Much Interest on Their Other Debt outside of as on their mortgages." So you have two primary sources of debt if you're running your household. The mortgage is the biggest one for most of us out there. The other components are your credit card debts, auto loans, other items like that. And this particular piece really, Mark, what it sums up is this dichotomy that we have on the interest rate front, where if you look at mortgages throughout the country, the average effective rate for most of us borrowers in the United States is around 3.8%. Credit cards, on the other hand, because of the increases that we've seen on the Fed fund rate side of things, are averaging around 21.5%. So as a result, interest payments through the U.S. on the mortgages, interest is very low because of the interest rates that many of us were able to refi into or lock in during the pandemic. Conversely, for those who do carry credit card debt, it's much higher than it's been previously. And so an interesting study here, but really it's just pointing to the difference in rates.
Paul, my reaction to this is, so what? I think the right way to look at this, Bloomberg, you ignorant whatever, to make a Dan Aykroyd reference.
I was thinking The Office.
You familiar with
there's another one with The Office.
Mine goes
but we
back to
won't go
the
into
70s. Bloomberg, you ignorant analyst. Aykroyd used a more colorful adjective in this. Anyway, so what? The right way to look at this, I think, is not one interest payment relative to another. It's total payments. You can look at non-mortgage if you want, inflation adjusted, which they did deflate their data, which you should, and then look at that relative to, say, not another form of interest payment, but disposable income. And when you do, you see that interest payments on non-mortgage debt as a percentage of disposable income are vastly higher than they were in the 2010s. Less than a fraction of a percent in the 2010s. It hovered around between 0.7 and say 0.9%. Today it does look dramatically higher than 10 years ago, 1%. But relative to the 2000s, when it was routinely above 1%, relative to the 90s, when it was routinely above 1.1, 1.2%, relative to the 1980s. We don't show charts on radio, probably for legal reasons, but Paul, does this, just give me your gut reaction, does this look like an emergency relative to this? This is the time series of debt, of interest payments deflated, so adjusted for inflation, relative to real disposable personal income. It looks like we're back on a gradually declining trend line to me. Just eyeballing it, so I'm not sure what the five-alarm fire is here.
To quote Dumb and Dumber, our pets' heads are not falling off just yet in terms of a debt perspective. I don't feel that it is of concerning levels at all here. And the thing that frustrates me, Mark, with some of these pieces here regarding credit card debt is they so often pick this low-hanging fruit, and by they I mean just the national media out there, whether it's Bloomberg, CNBC, Wall Street Journal, that credit card debt has exceeded $1 trillion. They constantly hit on that number. $1 trillion is a lot. However, there's been inflation over the last 20 plus years, particularly over the last 3. So when you're comparing a numerical number in 2024 to 2020, to the early 2000s, you have to adjust for inflation. And that's what bothers me.
Which they did in this piece, but the $1 trillion number, which is eye-popping on its face, they generally don't. And I'm not suggesting, by the way, that some people aren't having a tough time getting by. That's a different argument. The equity argument, the distribution of income argument, the role of government in making it easier for people who have big debt, student loans, whatever, to carry that burden. Different argument. The question here is, does this indicate some sort of red flashing warning? And I'd say, considered out of context like this, the answer is no. If you put it into a model and say it's got predictive value or something, like you're doing actual research and not writing a breezy article about it, maybe the answer is yes, but it's not obvious to me from the points made here that this is anything that anybody needs to worry about. So you could check that off.
Yeah,
Take that off the list.
The debt levels are not something that you're overly concerned about for the U.S. consumer. It's if you look back at history, Mark, to your point, 2007, those periods of time where you start to see them at significantly high levels. If they were to approach those levels, maybe cause for concern. But if you look back over a 30, 40-year period, these percentages that we sit at today are not overwhelming by any means.
What I said should be qualified. Rates were a lot higher in the early 1980s, higher than they are today. So interest payments were obviously more as a percentage of real disposable income. So my breezy take on this isn't very rigorous either, but it's, again, not obvious to me that this is a big problem right now. If rates go up and if unemployment goes up, then it's a very big problem.
Right. That's certainly an important caveat to point out.
Rates go up more, I should say.
The next piece that I want to touch upon here that I've queued up a special sound effect for us is President Biden and his efforts to launch a joint FTC DOJ task force to crack down on unfair and illegal pricing. And I'll bring in my favorite Dwight Schrute to give a breakdown of Biden and his task force and see where they rank.
Question: won't that interfere with your other task forces?
Answer: no, because this is being given priority one.
Priority one task force out there. We're going to crack down on unfair and illegal pricing. These companies out there, Mark, have been gouging the American people with these late fees and unfair business practices. It's time to come after them. A lot of sarcasm that you detect there. To me, this piece is just what we've seen so much of recently here. Political posturing to try and combat the notion that in the polls, a lot of Americans have been dissatisfied with the economy, probably unfairly if you look at all the metrics. But this idea that there's going to be some super duper task force that's going to come in here and resolve all the issues of the American people regarding corporate price gouging, to me, is just kind of laughable.
No, it's election year theater, obviously. I thought the sound effect was going to be Biden falling off the stage into an orchestra pit or something.
Well, we need video for that.
And then saying this idea fell flat or something. So this is theater, obviously. It's theater because inflation is the increase in the average price or the average price level. And in the long run, it's a function of the supply of money. In the long run, in the short run, you can have shocks to demand like we did during COVID. There were several rounds of stimulus passed. That goosed demand. Supply was constrained. Those could be considered shocks. They pushed up average prices quite appreciably. Since subsided, though still not arguably back to where the Fed needs them to be. So stuff like this won't get down the average price level, won't bring down inflation. You might be able to score some political points with it. What they could focus on instead is, say, curtail, if they think inflation is still a problem, and I guess that's self-evident given the motivation behind this, they could work on measures to curtail demand, like cut the federal deficit, for example.
Right.
Or appoint a Fed chairman who's tougher on inflation, who will react preemptively to it rather than let it wash over us, as Powell did.
Right.
So there are things the federal government can do. This probably doesn't rank high among those things that are likely to be effective.
No, it's such low-hanging fruit that they're trying to chase after. There's a big push to combat credit card late fees, which would allegedly save $12 billion a year for the American public. I don't mean to poo-poo the $12 billion, but if you look at the scale of the economy, it's just really a drop in the bucket. It's not entirely significant. I did try to research, what were some of the price measures that they've actually impacted, because there was a quote in here from Lael Brainerd saying that they had made impacts on EpiPens and I think it was inhalers and things like that. So that was something that is significant. Medicare, the ability to negotiate some of those drug prices, that is something that will take effect in 2026 for some of the negotiations. So there's been a little bit of impact there, but these late fees and other measures really are just political posturing.
Yeah, so maybe I'm misunderstanding the intention of this. It's not so much to get inflation down as it is to appease very specific constituencies.
Right. We're going to take a break here on the Financial Exchange, but when we come back, we're going to be talking about Target. They reported their earnings from Q4 right after this break.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. Is there anything better than sitting on a beautiful beach, watching the sunset with an ice-cold drink? You can experience that right now by booking your next vacation to the United States Virgin Islands. St. Croix, St. Thomas, and St. John are all unique in their own special way. And if you head to usvi.com, you can create the vacation of a lifetime. Whether it's the rich history of St. Croix, the pristine beaches of St. Thomas, or the spectacular nature of St. John, the USVI has a little bit of everything for today's traveler. Upon arrival, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to usvi.com. Whether it's a romantic getaway or a family vacation, the U.S. Virgin Islands has everything you need to enjoy. The vacation of paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Life estates are not simple documents and can create the potential for you to lose control of your estate. Cushing & Dolan are experts in elder law and have nearly 40 years of experience helping families with their estate planning. And their new guide, called Calculating the Consequences of Life Estates, can help you make the right decisions about how to protect your assets from probate and the nursing home. Life estates carry a higher risk of income tax penalties and hidden gift issues, and while they can be beneficial in some cases, if you use one, you need to be aware of the pitfalls they may cause. If you haven't done your planning yet, now's the time to learn about the effects that life estates can have when it comes to protecting your assets. Call Cushing & Dolan today at 866-848-5699 and request their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699. Or request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
The stock market recently reached all-time highs, but with the volatility we've seen over the last several years, there are no guarantees it'll stay there. This is Susan Powers from the Armstrong Advisory Group. While job growth is strong and inflation has declined, the past few years have shown us how rapidly conditions can change, which is all the more reason for you to have a financial plan in place that is built to withstand the ebbs and flows of the stock market. Our new monthly guide is called Building a Financial Plan, and in it we discuss the process of putting that plan together, including the importance of setting goals from paying off debt to saving for retirement, as well as a variety of additional planning strategies. Call our office at 800-393-4001 to get your new guide today, or you can request it online by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
There are many ways to protect your assets from the nursing home. If you use a life estate, that can create problems, including the possibility of losing control over your estate. Call Cushing & Dolan today at 866-848-5699 and get their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699. Or request it online from their website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Get up-to-the-minute market updates with Wall Street Watch, weekdays at 10:30, only here on the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. Visit the U.S. Virgin Islands and enjoy your next incredible vacation. Explore St. Croix, St. Thomas, or St. John, and enjoy pristine beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com.
Target came out with their Q4 earnings numbers pre-market this morning, and the market appears to be reacting quite positively to the report, with Target stock up over 12% in the first hour of trading here. What they reported here was, to be clear, the annual revenue that they came out with declined for the first time in 7 years. They saw a decrease of about 1.6% from the prior year in terms of the revenue numbers that they did. They also saw a weak decline in comparable sales in their existing stores in Q3, a drop to Q4 of about 4.5%. Other news that has the market sort of on a more positive uptake is they did see their profit bounce back a little bit. Their operating margins jumped from about 3.7% to about 5.8%. A lot of this is due to the fact that Target struggled with the shift in spending that the American consumer has had, where there has been less of a focus on discretionary spending for items like electronics and home goods and things like that. Much more of a focus from the American consumer more recently on the necessities, food and other items like that. Walmart makes a lot of the bulk of their revenue from its grocery business, where Target has a grocery business, but it's not as robust as Walmart's. They tend to benefit from some of these other discretionary items. They've still seen kind of a decline in traffic as they've gotten over the inventory glut that they had in these discretionary programs. They also announced that they're going to be offering a membership program out there to rival Amazon Prime and Walmart. Is it Walmart Plus, Tucker, that they have? Everything's Plus nowadays.
I believe
so
that's what it is.
I just go with that. Well, Target, they didn't go with the Plus for the naming. They go with...
It is Plus, yeah.
Is it Plus?
Walmart Plus.
Oh, Walmart Plus, yeah. The Target went with Target Circle 360. This is just being announced today. It will be offering free unlimited same-day delivery for orders over $35 in little as 1 hour. They've also got some other pricing tiers that will launch in early April that will be a little more expensive. So trying to keep up with their rivals, Amazon, Walmart, and Costco have made much more significant strides from a revenue perspective and inroads there. But overall, the market appears to be cheering a bit some of these profitability numbers, Mark, that we saw here from Target.
Yeah, big beat on earnings, which is what you care about.
Yep.
Earnings per share as a stock investor. I'm not my area. I'm not a consumer defensive stock analyst, but I go with what markets are signaling, and everybody seems to be pleased with the results and the prospects for continued good results.
It's a company that's been really sensitive to earnings reports recently. If you look back in May of last year, the stock took a significant hit when they came out with some of their numbers there. Again, it appears the market is applauding their recent announcement. It'll be interesting to see what type of inroads they'll be able to make with this loyalty program here on Target Circle 360.
So what's the deal? Is that subscription based?
It is. It's a paid membership program similar to Costco structure, Amazon Prime, Walmart Plus.
Do they say what the fee's
It's
going to
be $49 a year, which is significantly
$50
less.
a year for same day delivery if you buy $35 or more worth of merchandise.
Correct. Also, two free day shipping will be
because
a part of the
you get
price
that.
as well.
I mean, I have a Target debit card, and I get that now. It's not same day.
2 day, you get the free shipping on
I do.
2 day.
Sometimes
Yep.
it comes in a day.
Right.
Not clear to me unless you urgently need. Now, you could pay for delivery now. In fact, if you order a certain amount of stuff, maybe limited to the food category, I don't know, you get free same day on certain items. So on the margin, what's the benefit? What am I missing?
The delivery component.
Yeah, well, I'm just okay. So in the edge case that you need it same day,
right.
But you still have to spend $35.
I mean, Target is flat out acknowledging they're well behind the curve here in terms of their subscription programs, if you will, because if you're coming in at $49 a year, Walmart's $98 a year
for the same terms
and
same benefits.
Prime's 90, right?
Prime is
Prime's like
$139.
$130.
$140. Yeah.
Yeah. I mean, I subscribe to Amazon, and we shop at Target, not Walmart, because it's nowhere near us, really. So, I don't know. Might want to consider this if it's $49. But then again, it's pretty convenient to get same-day delivery with Amazon and the likes.
Right.
I'm already in that environment. Like, I don't want to leave Amazon now.
That's true.
But let's see how this goes. I don't know.
Their logistics are really tough to beat. We know that. It will be interesting to see what Target can do to make inroads there. You're right, Tucker. They're really far behind when it comes to Walmart and Amazon.
Why try to beat Walmart and Amazon at their game there? I don't know. I'm just speculating. Again, not my area, but just thinking out loud here.
Because you play in the same space, really, in terms
I don't
of
think
the
they're
items.
I don't think they're trying to beat them.
Just trying
they're
to keep up
acknowledging
with it.
they're
Just-
so far behind here.
It's basically to diversify revenue, their sales streams here, because they're admitting that the traffic in the stores has been down significantly. So perhaps a pivot to e-commerce or more delivery is what they're focusing on with this move would be. I'm not saying that's the most profitable way to go about it, but it's diversifying how you make sales.
Yeah, no, I didn't see the press. I didn't listen to the analyst conference, press conference. So maybe they clearly articulate this as a strategic priority, and it's coherent. I'm getting fragments. So
I think with the decline
make
in
sense.
same-store sales, you have to come out with something new to try and address the weakness in sales.
close some weak stores. I mean, EPS looks good.
Well,
As a shareholder, you think
That
well,
number is taking out stores that have been closed, the decline in
Right,
in
I'm saying
sales,
close more.
Close more, okay. Apple's iPhone woes in China
Fire them all.
deepen with a 24% sales plunge. Apple, over the first 6 weeks in China, saw a 24% decline in their iPhone sales. Huawei made a significant jump in terms of the domestic option in China. It looks like Apple's market share has been peeling back a little bit. You continue to see this. BYD is another example of this, where the Chinese population, probably largely influenced by the government structure, is buying more of their own products, and you're seeing companies like Tesla and Apple have a hard time keeping up with increasing sales there. You also have an economy that's pretty weak in China as well, which we'll get into.
Yeah, it grew 5% last year. I'd like to be that weak.
I can't wait
Relative.
to get into to that in the next segment here. Just to continue to wrap up some of the Apple tidbits here. The stock is down 2.5% on the news. The market share that Apple has in China was about 19% over the first 6 weeks of the year. It's dropped down to 16%. Also, Hanhei Precision Industry Corp, which does a lot of the assembling of the iPhone, saw a 18% drop in sales. So a little bit of weakness there. Apple also offering some discounts on their store in January, which you don't often hear with Apple, to try and address some of the weakening demand. And as I mentioned, a little bit of a peel back for the stock today.
Does
but,
iPhone have a we can talk about this on the other side, I guess.
We're going to take a quick break here on the Financial Exchange. When we come back, we'll have Wall Street Watch and talking about China's economic growth. That's right after this break.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Is there anything better than sitting on a beautiful beach, watching the sunset with an ice-cold drink? You can experience that right now by booking your next vacation to the United States Virgin Islands. St. Croix, St. Thomas, and St. John are all unique in their own special way. And if you head to usvi.com, you can create the vacation of a lifetime. Whether it's the rich history of St. Croix, the pristine beaches of St. Thomas, or the spectacular nature of St. John, the USVI has a little bit of everything for today's traveler. Upon arrival, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to usvi.com. Whether it's a romantic getaway or a family vacation, the U.S. Virgin Islands has everything you need to enjoy. The vacation of paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
The stock market recently reached all-time highs, but with the volatility we've seen over the last several years, there are no guarantees it'll stay there. This is Susan Powers from the Armstrong Advisory Group. While job growth is strong and inflation has declined, the past few years have shown us how rapidly conditions can change, which is all the more reason for you to have a financial plan in place that is built to withstand the ebbs and flows of the stock market. Our new monthly guide is called Building a Financial Plan, and in it we discuss the process of putting that plan together, including the importance of setting goals from paying off debt to saving for retirement, as well as a variety of additional planning strategies. Call our office at 800-393-4001 to get your new guide today, or you can request it online by visiting ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi folks, Susan Powers and Chuck Zada here from the Armstrong Advisory Group, and we're talking today about our brand new guide for the month of March, Building a Financial Plan. Chuck, why is it important to build a financial plan?
Well, I think it's something that can give you some important guidelines as far as what you should be doing on a daily, weekly, and monthly basis in order to be able to hit those goals, and whether those goals are saving $100 into an emergency fund or trying to save thousands of dollars for a college education that may be coming in 15 years, you still need to have a plan for how to execute that on a daily basis in order to get wherever you want to be going.
So we know how fluid life can be, Chuck. What happens if you need to change your plan because your circumstances change?
Well, I think this is one of the most important things, is that a plan is just an initial guide for what you should be doing, but if things do change, you have to adapt that plan as well. So let's go back to what I was previously talking about with saving for college. If the picture for how expensive college is going to be in the future changes because of changes to student loans or things along those lines, you might say that you need to adapt your plan and change your saving strategy, and that's perfectly fine to do if the reasons, for doing so make sense and if the picture is different from when you initially started building that plan.
Folks, learn how you can develop a comprehensive financial plan to help you pursue your goals, whether they are modest or substantial. Call right now to request your free copy of our brand new guide, Building a Financial Plan, at 800-393-4001. That's 800-393-4001, or request your free copy at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets are in negative territory for a second straight day this week. A little bit of a sell-off, mind you. At the moment, the Dow is off by 0.5%. S&P 500 down over 0.75%, and or 45 points. And the tech-heavy NASDAQ is down nearly 2% now, down 287 points. Russell 2000 is off by nearly 0.2% as well. 10-year Treasury yield down by 8 basis points, now at 4.13%, and crude oil down over 0.75%, trading just above $78 a barrel. AMD shares down by 2% after Bloomberg News reported that the chip maker was hit with a regulatory snag that will prevent the chip maker from selling an artificial intelligence chip to China. The chips are supposedly too powerful and will require a license from the Department of Commerce's Bureau of Industry and Security to be sold. Meanwhile, according to Counterpoint Research, as the guys just mentioned, iPhone sales dropped 24% in China during the first 6 weeks of the year compared to a year prior. Apple shares down by 3% now. Elsewhere, Tesla shares down by 5% after the electric car maker paused production at its Berlin plant earlier today as a result of a power outage due to a nearby electricity substation fire. Police told CNBC the incident initially looks like arson. Stitch Fix shares down by 17% after the online clothing subscription company posted an earnings miss for its second quarter. The company also saw its active clients slump 17% from a year ago. And GitLab issued weaker than expected revenue and earnings guidance for the full year, where the software company also said it expects an adjusted loss of 4 to 5 cents per share for the first quarter, lower than previous forecast. GitLab shares down by 18%. I'm Tucker Silva, and that's Wall Street Watch.
China sets a high bar for their growth in 2024. Beijing has an official target of 5% growth for this year. China and economic growth forecasts, you should put as much weight into these numbers as, I don't know.
It's more uncertain an art than it used to be.
Yeah.
I mean, they grew really fast in the 80s and 90s when they freed up their late 70s, when they first started implementing free market reforms, very late 70s. They benefited from very high labor force growth and importation of technology without restrictions. Mm-hmm. That allowed them to have very high growth rates in gross domestic product, GDP, which is the best measure we have for gauging a country's output and ultimately welfare. 70s labor force growth, I did this when I read the article, using data that the Federal Reserve makes available, 3.1% a year. 1980s labor force growth, 3.2% a year. These are very heady numbers. These are like America in the 50s and 60s, a little better actually. 90s, things slowed down dramatically, 1.3% per year growth in the labor force. 2000s dropped to about 0.5%, and then 2010s a little less than that. So very clear trend line there. Going forward, we know demographics are baked into the cake. China's not going to have a big immigration surge. There isn't exactly a big line of people waiting to give up their individual rights and become citizens of China that I'm aware of.
No.
Anyway, so absent some technology breakthrough, and we and others have put the brakes on their ability to import productivity-enhancing technology. That probably won't slow them down very much, but it doesn't help. Hard to see how China generates anything like their target growth rates, which are significantly reduced from the 10% we saw in the 90s and the high single digits we saw in the 2000s, et cetera. Everything's slowing down there.
No, those are good points to make. The tongue-in-cheek point that I want to make is that when China has announced GDP targets since 1994, they've only missed on them twice. In 2022, they came in around 3.5% when their target was 5.5%. They claimed to make about 5%, to see about 5% GDP growth last year. Those numbers, like I said, you can't put a lot of stock in them. However, the takeaways from this metric that they've announced here is more the overall sense of where their economy is. And to all those points that you're making, Mark, it's an aging population with high youth unemployment, a property market from a real estate perspective that is in a significant amount of turmoil. And regardless of this 5% target that I've spent some time speaking about, there clearly was in this press conference that was carried out a initiative to make sure that they stimulate economic activity. They announced the special issuance of government bonds, about $139 billion of treasury bonds, in order to try and stimulate some growth here, and also try and assess some of the concerns that people have regarding falling foreign investment. There's just not a lot of demand for other countries to invest in China. There's been much more of a focus from an economic growth perspective on becoming more self-sufficient from a technology perspective. And Mark, as you mentioned, other countries have taken some significant policy implementation to make sure that China does not have access to the most advanced technology.
Command economies like China can generate impressive levels of growth for extended periods. The Soviet Union did it in the 20s, 30s. They didn't have a Great Depression. There were plenty of American stooges at the time, like Tucker Carlson recently pointing at Russia and saying, "Ooh, look how clean the supermarkets are. Oh, look, there's no graffiti in the subway." Well, yeah, that's because if you try that, they throw you in jail and you die 3 days later. So in a free society, you tolerate that. The price of the growth that I'll just call it a command economy, even though China's kind of mixed. Soviet Union was a clear example of a command economy during Stalin's heyday. It's very easy to generate high levels of growth because you put a gun to people's heads and you say, move from your farm into the city and go work in a factory. If you don't want to, you and your family die. That's not how we allocate resources here, which is why we've been able to generate using the right institutions that foster human, creativity, and productivity and all the things that are attendant with that, all the benefits that flow from those conditions. It's really about institutions, and China has never adopted rule of law based institutions the way the Western world has, which is why when their demographics go south, there's really no hope that growth comes from other areas unless they sort of steal it or generate productivity enhancing innovations organically, and it remains to be seen whether they can do that. And they also seem to have run out of fiscal room, by the way.
Yes.
In the past, they could say, okay, we want to grow by 8%. We just need another $1 trillion. I'm exaggerating here. The deficits there weren't that big. We could just borrow and hit that target. They're now fiscally constrained, too. So unless they fundamentally change in an institutional sense, is what I'm trying to say, become more, frankly, Western like us, as chauvinist as that sounds. And there's zero chance of the Chinese Communist Party doing that. They're going to have a very hard time, obviously, hitting these growth targets long term.
Certainly will be hamstrung to reach those targets here. We're going to take a quick break here on the Financial Exchange. When we come back, we'll be talking a little bit about Bitcoin as well as U.S. mid-sized banks and the commercial real estate market. That's right after this break.
This is your home for the most comprehensive coverage of the economy and the trends on Wall Street. This is the Financial Exchange Radio Network.
Everyone has financial goals, and regardless of what yours are, the process of establishing a comprehensive financial plan is key to achieving them. This is Chuck Zada from the Armstrong Advisory Group, and our new guide called Building a Financial Plan may help. Some goals are bigger than others, like saving for retirement, but even smaller goals like paying off your credit card debt can be an important part of a well-rounded financial plan. As you build your plan, break your goals down into realistic tasks, establish a savings strategy, or determine an asset allocation that aligns with your risk tolerance. It's also important to create checkpoints to help you monitor your progress and make sure your plan remains on track. Call us today at 800-393-4001 and ask for our new guide called Building a Financial Plan. That's 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Life estates are not simple documents and can create the potential for you to lose control of your estate. Cushing & Dolan are experts in elder law and have nearly 40 years of experience helping families with their estate planning. And their new guide, called Calculating the Consequences of Life Estates, can help you make the right decisions about how to protect your assets from probate and the nursing home. Life estates carry a higher risk of income tax penalties and hidden gift issues, and while they can be beneficial in some cases, if you use one, you need to be aware of the pitfalls they may cause. If you haven't done your planning yet, now's the time to learn about the effects that life estates can have when it comes to protecting your assets. Call Cushing & Dolan today at 866-848-5699 and request their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699. Or request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Is there anything better than sitting on a beautiful beach, watching the sunset with an ice-cold drink? You can experience that right now by booking your next vacation to the United States Virgin Islands. St. Croix, St. Thomas, and St. John are all unique in their own special way. And if you head to usvi.com, you can create the vacation of a lifetime. Whether it's the rich history of St. Croix, the pristine beaches of St. Thomas, or the spectacular nature of St. John, the USVI has a little bit of everything for today's traveler. Upon arrival, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to usvi.com. Whether it's a romantic getaway or a family vacation, the U.S. Virgin Islands has everything you need to enjoy. The vacation of paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
Taking a look around at markets, we've still got the NASDAQ down over 1.75% on the day. The S&P 500 is off almost 1% as well. One indice that is rallying quite significantly, reaching all-time highs, is Bitcoin. Bitcoin rockets to an all-time high of above 69,000, surpassing its 2021 record.
Can we not dignify Bitcoin by even talking about it? It is the most obvious scam I've ever seen in my not inconsiderable now lifetime. There's none of the arguments for it have panned out. You could text us if you disagree, but it was purported to be an inflation hedge, a trauma hedge, a hedge to traditional asset classes. As it turns out, it just co-moves with risky assets. It's very high beta as finance types. Sorry, I wasn't saying that with a Yiddish accent. There was something in my throat. It's very high beta. So it co-moves very intensely with equities. It doesn't hedge anything. No intrinsic value. Neither does gold have intrinsic value, but gold has historical value as a safety asset. Bitcoin doesn't have that. Why in the world, other than handing the bag off to a greater fool at some point, why would you own this thing? And my God, why would any level-headed, supposedly prudent fiduciary put it in a 401k plan? I've not seen that yet, but it's going to happen. The big money managers that record keep these things, I won't name them, you know who they are if you're listening. They have products that they're very eager to stuff into 401k and other qualified plans. Good luck.
I agree with all the sentiments. It's a really risky asset class.
No, don't call it an asset class.
Okay.
Call it a scam. Vehicle. I don't know. It ain't an asset class by any definition of asset class.
A sound estate plan has many layers. In some cases, using a life estate can be a beneficial piece of your plan, but they can also be problematic. Call Cushing & Dolan, the experts in elder law, at 866-848-5699 and request their new guide called Calculating the Consequences of Life Estates. In it, you'll learn about the significant issues that life estates can cause, including the possibility of losing control of your estate. Building the proper estate plan not only protects your assets from the nursing home, but also helps you avoid probate and potentially eliminates estate taxes. So be aware of the many problems life estates can cause before you create one. Call Cushing & Dolan today at 866-848-5699 and get their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated.
Recent crises in regional banks have become a real issue here. If you look back to Silicon Valley Bank, which we talked about for a significant period of time last year, now more recently you have New York Community Bank under a ton of fire for recent earnings reports. The stock is down over 70% year to date. And there's a piece here in the Wall Street Journal which talks about the sizes of banks out there and banks getting bigger and how it can be a challenge. Now, really what this comes down to, Mark, is the risk management of the respective leadership teams on these banks. And what we've seen in some of the regionals, Silicon Valley Bank had a different problem where they saw their deposit size just swell to levels that were just extraordinary. They had $60 billion in deposits in 2019, and then they had $170 billion before their collapse. So they were growing their deposit base, Silicon Valley Bank, at a rate where they just almost couldn't lend out the money fast enough. So as a result, they bought long-term treasuries. We all know the story. When interest rates rose, there were significant unrealized losses on their books, and then there was a run on the bank. Separately, with New York Community Bank, they don't really have the problem of deposits and uninsured deposits. 3/4 of their deposits are insured. They have seen a significant jump in their assets. From Q3 of 22, they had $63 billion in assets, up to $110 billion after some acquisitions over the course of the last year or so. It's really been the growth and sort of lack of risk controls in place that has caused some significant issues here.
Yeah, there's a funny quote in this article, and I'll read it. You may not find it as funny as I do, but one executive says, it's actually a NYCB executive, as we continue our transformation into a larger, more diversified commercial bank, it is imperative that we strengthen the company's risk and compliance framework, yada, yada, yada. You would think strengthening it would come first. You would evaluate whether or not you had the capacity to take prudent risks, that your shareholders would be holding your feet to the fire on that. To me, this is the downside of federal deposit insurance. It's in some ways mitigated the business cycle nicely. Most economists who look at the smoothing out of the business cycle since the end of World War II attribute it in part to deposit insurance. You don't have runs on banks anymore for the most part. The moral hazard downside to that is that we don't ask what banks are doing with our money. I just assume that B of A is going to make good. Now, they're a big, diversified institution that we now know is too big to fail.
Right.
Because evidence has borne that, experience has borne that out. But nobody has any incentive to ask whether their local co-op, which I use in my town, is investing funds prudently. I think they are, but I don't ask to see their book. I'm not incented to because my deposits are insured. So we are not vigilant consumers. Caveat emptor does not apply. Does not apply, to personal banking.
What were some of the historical ramifications in previous times when there wasn't the FDIC insurance? What were some of the
bank
impacts?
runs, credit crunches, money supply shrinking?
Right.
So the problem during, for example, the early 1930s was a massive decrease in the money supply, broad measures of money supply, even though the Fed didn't contract the money supply, and they often get blamed for the Great Depression. The fact is nobody was lending. People were pulling their money out of banks, businesses and
Distrust in
consumers.
banks, yep.
So you had overall money supply fall. You had massive deflation. Actual price level coming down as a result. So deflation, which is devastating, especially when no bottom is obvious, is one consequence. The other is, of course, a credit crunch.
The other thing that we've seen in the banking side of things is that there has been a significant amount of mergers and acquisitions. We covered on the show, Capital One has acquired or is attempting to acquire Discover Financial Services for $35 billion. That already will make for the biggest bank merger in 2 years, really, that we've seen here. And there's a lot less options out there for small local banks. It seems like there are much more of these banks that have grown significantly in size, and that is difficult. It becomes problematic for consumers when you don't have enough options. I'm not saying we're to that point yet, but there certainly is less options when you look at the small town banks out there that many people enjoy working with.
Really, because I would say just anecdotally, it seems like there have never been more small banking. I don't know. That could just be my perception. And they do, as the article alludes to, and I think as we've talked about before, they tend to offer better, they tend to perform more, I'll just call it intensive underwriting perhaps. Maybe they just know their credit risks better, i.e. they know us better. So you can get more competitive rates at times, right, from smaller institutions?
I would completely
on both sides,
agree
both as a borrower and as a lender.
I would completely agree with you that from a deposit base, Bank of America does an absolutely atrocious job intentionally of not offering any type of interest for any deposits that you have on your balance sheet. That speaks to their size and the regulatory scrutiny that they're under, where they have specific capital ratios that they're supposed to meet, and lending against their deposits, they're really just not providing a lot of interest. So having those smaller bank options is something that is really important to be able to get a CD or get a money market at a more reasonable rate. I'm not saying that there is not enough options out there, or that we're bereft of them, but certainly there seems to be a little bit more consolidation in the space. The regional banks definitely got beaten up a little bit from a deposit base size because of that too big to fail piece where we saw, and then that's resumed back to normal, but we saw a lot of deposits going from some of the small regionals to the larger financial institutions during the Silicon Valley bank crisis there. Wrapping up the first hour of the show here, as we take a look around at markets, we've got the Dow Jones off over 240 points at the moment, or 0.6%. The S&P 500 is off 0.85%. And the NASDAQ continues to struggle as Apple's shares have been lower, trading throughout the first couple hours here. That's all the time that we have for the first hour of the Financial Exchange, but stick with us here. We've got much, much more to cover here on the second hour right after this break.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today, we're talking about the use of life estates and your primary residence. Todd, does the 5-year waiting period for Medicaid eligibility apply to the creation of a life estate?
Well, the short answer is yes, it does. But let me explain why it does. So, first of all, when you create a life estate, again, the general way people do it is they tend to put the remainder interest of the property in the hands of children. I don't like it that way, but that's how they do it, when you could have the remainder interest with a trust. But the moment you put the child's name on the deed and you reserve the right to live there is a completed gift for gift tax purposes. No one thinks of that, but now you technically need to file a gift tax return. And it's that creation of the gift, it's that transfer of that remainder interest in the property to the child for less than fair market value that triggers the disqualification period for Medicaid. So that's why you have to wait 5 years after you create this life estate arrangement in order for the house to be protected from the nursing home. It's very hard to avoid the 5-year waiting period, folks. There's really not too many ways around it.
Learn how you can avoid probate, eliminate estate taxes, keep your money in your family, and protect your assets from the nursing home. Request this brand new guide from Cushing & Dolan. It's called Calculating the Consequences of a Life Estate. You can get it by calling 866-848-5699. That's 866-848-5699, or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Are you retired like me and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it, and your property. If you owe the IRS back taxes or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right. If you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
Do you use the expensive blue or yellow pills to charge your sex life? Are you thinking about it? What if we can promise you the same results for less than $3 a pill? If you're paying $20 a pill for the other pills, you're getting taken to the cleaners. Our pills deliver the exact same results for less than $3. You'll save more than $16 a pill for the same results. And right now, radio callers will get 44 blue or yellow pills for $120 with free discreet shipping. You can save more than $700 off pharmacy prices. Charge your sex life now and save a ton of money. Call now and get your 44 pills and save over $700 and qualify for free shipping. Stop overpaying and call right now.
Paid for by Steel Man Pills. 800-475-8547. 800-475-8547. 800-475-8547. That's 800-475-8547.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line.
With the stock market remaining volatile, it couldn't be more important to have a sound financial plan. I'm Mike Armstrong from the Armstrong Advisory Group. There are risks with any investment strategy, and that's why we've written a brand new guide to help you understand those risks and how they can be associated with any financial decision. It's called Building a Financial Plan, and it may help you recognize the potential risks and rewards that are associated with your investment strategy, in addition to offering insight into how to research making the decisions that are best suited for you and your family. The guide also provides information on how to establish clear financial goals and what steps might be needed in order to achieve them. Call us today at 800-393-4001 and ask for your free guide today. That number again is 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
There are many ways to protect your assets from the nursing home. If you use a life estate, that can create problems, including the possibility of losing control over your estate. Call Cushing & Dolan today at 866-848-5699 and get their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699, or request it online from their website, legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Is there anything better than sitting on a beautiful beach, watching the sunset with an ice-cold drink? You can experience that right now by booking your next vacation to the United States Virgin Islands. St. Croix, St. Thomas, and St. John are all unique in their own special way. And if you head to usvi.com, you can create the vacation of a lifetime. Whether it's the rich history of St. Croix, the pristine beaches of St. Thomas, or the spectacular nature of St. John, the USVI has a little bit of everything for today's traveler. Upon arrival, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to usvi.com. Whether it's a romantic getaway or a family vacation, the U.S. Virgin Islands has everything you need to enjoy. The vacation of paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Paul Lane and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Paul Lane and Marc Fandetti.
Welcome back to the second hour of the Financial Exchange. Taking a look around at markets all in negative territory today as Apple is down close to 3% off some negative news regarding their sales in China. 24% drop in iPhone sales over the first 6 weeks in China. We also had Target reporting its earnings. The stock is up over close to 12%. A relatively quiet day in terms of economic data. However, we will have Chairman Jerome Powell speaking tomorrow, and we'll be covering it on...
Oh, boy. I'm sure that'll clear things up.
We'll be covering that in detail tomorrow.
He's forced to give this testimony. So this isn't an example of a Fed official trotting out there, self-inflicting wounds on the Fed by further confusing us with what the Fed's intentions are.
We'll also have the labor market report coming out on Friday, but we start the second hour of the show with just some overall commentary on the market and where we sit today from a valuation standpoint. One of the things that often gets talked about when you see a significant surge like we did in the equity markets last year, where the S&P 500 gained 26%, and year to date, I believe we're hovering around 8% for 2024 in terms of the S&P 500. Yeah. Are we in a bubble is a question that will often get brought up. And Marc, I'm curious your thoughts on this piece here in Bloomberg, which talks about not only valuations, but this idea of can the market continue to rise?
Short answer is yes. Mm-hmm. The longer answer is it depends. And the short answer over the short term is, yeah, of course. Markets are sentiment driven over the short term. You could argue they're technically driven. Factors like momentum, not entirely a technical factor, but I'll just use that as shorthand, can easily dominate in the short term. The reason why people were alerted to the possibility of, I'll just call it frothiness, because I hate the term bubbles, because everybody's got their own definition and you never really know until after the fact. And some things that appear to be bubbles are, in retrospect, justifiable. The growth potential really was there. But when people say a bubble, they generally mean the price has become detached from any reasonable estimate of fundamentals. If your home price doubled overnight, you'd probably, absent a big influx of people into your neighborhood demanding homes, you'd probably call that a bubble. I.e., if nothing fundamental has changed, you might chalk that up to just
That's a good way to explain it.
Irrational exuberance. Now, it doesn't mean it's not justifiable. The people pushing the price up could end up being right. It just means it's hard to justify given a sort of level-headed, clear-eyed examination of fundamentals. The reason why last year's rise, about 26% in the broad stock market, got bubble watchers' attention is earnings barely went up. So last year's rise was due entirely to people's willingness to pay more for a dollar's worth of earnings, which reflects optimism, which may or may not be an optimism about future earnings growth, which may or may not be borne out. Look, long-term investors should pay no attention to this talk, as those of us who lived through the tech telecom bubble learned the best policy was to stay invested, continue to dollar cost average in, don't look at your statements, and rely on the sort of uncanny wealth generating power of stocks over the long term, about 12% a year over the last century using Morningstar Ibbotson data. We recalculate that regularly, and it's been remarkably constant, even over shorter term periods. So that's probably not a good a forecast for stock returns, given that they do look a little pricey right now. at least over the medium term, at least in terms of a medium-term forecast. But setting it and forgetting it to the extent that's consistent with your horizon and tolerance of risk has been the best policy and should, absent big structural changes in the economy, continue to be for individual investors.
One of the theories that was pitched to me recently, and this is more anecdotal, not exactly supported by hard numbers here, is that there is a significant amount of money, quote unquote, on the sidelines here. They are mentioned in this piece that pensions and endowments still hold a relatively low stock exposure to where they've been historically. You have a significant amount of dollars in money markets out there because people are actually able to pick up some interest there. Is there, perhaps a case that could additionally flood the markets?
Pension money market dollars may not be sitting on the so-called sidelines or may not constitute dry powder. Those might be earmarked for future private market.
I guess two
So
separate. I'd separate those two ideas. The pension and endowments having low equity exposure is one of the pieces,
and they don't really have low equity exposure. By the way, they have very high private market alternatives exposure.
Right.
We've all heard of private equity. Those are companies that aren't publicly listed. There's private credit. There's infrastructure. There's agriculture. There's private real estate. That constitutes probably these days a majority. I was going to say close to. It's probably a little bit more than a majority of, say, very sophisticated pension fund that are in good funding shape, and certainly endowment, like college endowment assets. They look equity light only superficially. They've got a lot of very growth sensitive private market asset classes.
Mm-hmm.
As for retail investors, you and me and people listening, maybe we do have a little bit more in money market than we normally have. If there's a little tactical bucket in our personal portfolios that we could use to switch back and forth, but most people don't invest that way. They're on autopilot through their 401k. Your money gets defaulted into a target date fund, which is nearly always fully invested. So I'm always skeptical about people assigning purposes to money in money market. It may not be money on the sidelines. It might be that an older population chooses to keep more there.
We've certainly reached, from a price to earnings perspective, like you said, a bit of frothiness. So it will be interesting to see how the rest of the year plays out. A lot of the macroeconomic issues that we talk about need to be not resolved necessarily, but as we get more clarification there, then we'll get more clarity.
I mean, should we talk about risks to that scenario? Look, stocks are expensive relative to
where they've been historically.
And one way to measure that is using some sort of price to earnings ratio. When we say price to earnings, you hear two things. You hear price and earnings. Price is pretty straightforward. It is what it is. The earnings, which is in the denominator of PE ratio, that's where people employ judgment. You could use trailing 12 months. You could use forward earnings, what analysts think will happen. You could take the last 10 years, adjust them for inflation, and average them. That's the cyclically adjusted PE. That smooths out the ups and downs of the business cycle, and academics like that particular measure. They all do suggest that stocks are more expensive on a PE basis, which is just like using price per square foot for your house. It allows you to compare house to house. It allows you to compare your house today to what it would have sold 4 or 5 years ago. It's a nice objective way of making apples to apples comparison. Those measures do look high. And those measures are, to an extent, predictive of future returns. The more you pay for something, the lower the return, just like with a bond.
And there isn't a projection of significant earnings growth on the denominator side for this year baked into some of these forward-looking calculations as well.
Yeah, I don't know what the average. It's I think it's low single digits, right?
Right.
Is the so 12 last time I looked at it, somewhere in the 12 to 14% range. So maybe these high, if you expect that this year and you expect no recessions, which is not likely, which is why you got to think about risks to these sort of more optimistic year-end targets. What if inflation is not under control? I'm personally in that camp. It feels elevated. To me, this doesn't feel like a disinflationary economy. It's growing hot. Unemployment is low. What if that Fed rate cut projection that markets seem to be counting on turns out to be wrong?
It's certainly become a more convincing argument to make that this idea of rate cuts this year may be a little bit premature. So it's something that we'll have to continue to monitor. We're going to take a quick break here on the Financial Exchange, but when we come back, we're going to be talking about the tech industry and Apple and Google and Meta and their demand for more AI workers out here. That's right after this break.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
The stock market recently reached all-time highs, but with the volatility we've seen over the last several years, there are no guarantees it'll stay there. This is Susan Powers from the Armstrong Advisory Group. While job growth is strong and inflation has declined, the past few years have shown us how rapidly conditions can change, which is all the more reason for you to have a financial plan in place that is built to withstand the ebbs and flows of the stock market. Our new monthly guide is called Building a Financial Plan, and in it we discuss the process of putting that plan together, including the importance of setting goals from paying off debt to saving for retirement, as well as a variety of additional planning strategies. Call our office at 800-393-4001 to get your new guide today, or you can request it online by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
There are many ways to protect your assets from the nursing home. If you use a life estate, that can create problems, including the possibility of losing control over your estate. Call Cushing & Dolan today at 866-848-5699 and get their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699. Or request it online from their website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated.
Hi folks, Susan Powers and Chuck Sauda here from the Armstrong Advisory Group, and we're talking today about our brand new guide for the month of March, Building a Financial Plan. Chuck, when it comes to building a comprehensive financial plan, what components should you include?
Well, I think you have to look at all of the big ticket items to make sure that you're accounting for them. So things like, do you want to retire, and what's the timeline on which you want to retire? What's your plan for housing? Are you planning on renting and just allocating a portion of your income on a monthly basis to rent? Or do you want to be buying a place, and that needs to be one of the goals that you integrate into your plan? Other things might depend on whether or not you have children, like saving for educational expenses or things like that. And then obviously, you might have other things that pop up along the way as well. Smaller things. Hey, do you need to save for a vacation next year? Or things along those lines.
So what's the best way, Chuck, to go about defining your goals?
Well, I think you really need to think about what's actually important to you in terms of how you want to live your life. It's not so much a financial discussion at first, but more thinking about what you actually want to do with your life. So if you say, look, I'd love to spend my time down in Florida more often, okay, that can get you thinking about whether you need to rent a place down there, buy a place, or some combination depending on what your life circumstances look like. So I think that's a great place to be starting.
Folks, learn how you can develop a comprehensive financial plan to help you pursue your goals, whether they are modest or substantial. Call right now to request your free copy of our brand new guide, Building a Financial Plan, at 800-393-4001. That's 800-393-4001, or request your free copy at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Breaking business and financial news first throughout the day. Only here on the Financial Exchange Radio Network.
Time for trivia here on the Financial Exchange, and it's brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m., including half-price boneless buffalo wings, half-price spinach and artichoke dip, and half-price warm pretzels dipped in beer cheese. Gather with friends any day of the week at Applebee's and say hello to half-price appetizers served late night, because half off is just more fun. Now that's eating good in the neighborhood, void where prohibited. Dine in only. Well, today is Penn Jillette's 69th birthday. After graduating from Ringling Brothers in Barnum and Bailey Clown College in 1973, Gillette began performing street magic until a fateful meeting a year later that led him to creating the most successful magic duo of all time. Trivia question today: what is the name of Penn Jillette's magic partner? Once again, what is the name of Penn Jillette's magic partner? Be the 9th person today to text us at 617-362-1385 with the correct answer. And you win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Applebee's. Be sure to include the keyword Applebee's in your text, and we'll give away that Applebee's gift card on Friday's show. 617-362-1385, and the 9th correct response will be our winner. See complete contest rules at financialexchangeshow.com.
Tech giants are finally being forced to bow to the global push, particularly from the EU, to have some regulations imposed on their technology. We saw earlier this week, Mark, that Apple was fined $1.9 billion by EU regulators for thwarting competition on their music streaming platform from rivals. We've also seen some regulations out there regarding Windows customers no longer having to use Bing Internet Search Tool as by default. Apple has also
Thank goodness. How annoying. No, but look, nobody uses it.
No one does.
If you use it, please text us because we want to show you how to set up Chrome. But how annoying is it to have to change it? And then whenever Windows updates, you have to change it again. They keep trying to force you back to this. Frankly, to this point, maybe someday this will change. It's a sort of inferior platform.
Stop trying to make it happen. Chuck is a big proponent of DuckDuckGo as a search engine. And to me, I just never understood why he likes it so much better. His claim is that he just is against Google's practices and the way they auction off ads on their platform. But
he's saying that the search results are far and away better on DuckDuckGo.
Yeah, that's what I question a little bit. I just
how would you know that? So you run them, you do a horse race, and you
side by side. He believes that you get them better.
He thinks that Google's search results have gone downhill significantly,
and I just haven't seen that.
No, I haven't either.
I wouldn't even begin to know how to measure that.
Like it's a little more annoying on Google because you have to go through the top
the first
2 or 3 sponsored
paid
ones.
Ad, yeah.
But whatever.
Yeah,
it's just still pretty good.
Just part of the game. Then we've also seen Apple have to make changes regarding its App Store and how payment systems are utilized through its technology. All of this really points to the fact that it's a maturing industry. Technology has really evolved more rapidly than legislation has, and we're now seeing the European Union is really the one leading the charge in this, but there's been a lot of different laws put in place. To me, it seems like to the betterment of us as the end user.
I guess.
I'm still not.
I don't feel like I was a victim of Apple's App Store. Do you? I can't say that I don't make a ton of purchases there. I don't think I've made any in the last 6 months, but I can't say that I've noticed. I've never felt victimized.
I don't personally feel victimized, but
by a technology giant.
I do like how on the Digital Service Acts of 2022 Europe, for those who are under the age of 18 on Instagram, TikTok, and Snapchat, they'll no longer be able to have ads based on their personal data presented to younger people. So to me, I think that's a positive to not be putting specific ads out there to younger, more
protecting
susceptible
minors
people.
is one thing. Things that limit choice, although many of these changes appear to be intended to expand, not inhibit choice.
Mm-hmm.
On the surface, it's hard to argue with them because you sound like you're defending
Monopoly
a company that has monopolistic pretensions or ambitions, even though in a free market that's really, really hard to pull off, absent some natural monopoly circumstances like utility. You can only have one. You can have multiple companies transmitting power, but only one can own and maintain the power lines. Natural sort of monopoly circumstances. These have never struck me as meeting that standard, so I always kind of scratch my head when I look at this stuff. But this could be just political theater too. Well, what am I saying? Of course it is.
It's interesting that the EU has just had so much more success in passing laws versus the United States continues to struggle.
Yeah,
and
sure. We do all the innovation, and they freeload.
They come in.
Well, they do though. I mean, they're more social welfare oriented.
Oh, of course.
So they sit around.
Of course.
Wait for us to innovate.
Lena Khan was supposed to come in and really make significant antitrust changes.
She's trying, right?
She's trying her best, but
she's a little dynamo.
We've used the example of Amazon, and you mentioned this idea of feeling victimized by any of these business practices, and I believe we were on the show together where you've never felt as if Amazon is ripping you off or doing a disservice to the end consumer with any of the offerings that they have where they promote their products or specific private listers on their site more than others.
No, because I do this little thing called shopping around.
Right.
And I go to Target and I go to Lowe's, and Amazon invariably has probably the best price and better. It's happened twice in the past week, and I don't buy a lot. So I don't know if I'm a good example or a bad example. But invariably, Amazon is competitive and gets it to me quicker. And if I have an issue with it, I squawk, and they usually just say, keep it, we'll send you another one. And then I've started feeling guilty about that, so I don't do it as frequently. But anyway.
I wonder if there's going to be a moment of reckoning on that where they start to be a little bit more difficult on it.
Look,
but
if they haven't kicked me out of Prime, they're not going to kick anybody out of Prime.
I'm sure there's worse offenders out there.
Yeah, maybe.
Oh, I don't know. AI talent is in demand as other tech job listings decline. The tech sector has been one area of the labor market, Mark, where we've seen a significant, not significant is probably overstating, we've seen a bit of a decline in terms of available jobs. There's been more layoffs in that sector. Of course, as you can imagine, with the amount of spending that we've seen from a lot of these companies on NVIDIA's AI chips and others out there, there's a lot more focus on AI-related jobs rising in the market with higher pay. It's certainly an area that's really in its infancy. We've talked about that a lot on the show. We owe a lot of the stock market gains to this idea of perhaps future productivity enhancements or profitability enhancements from this technology. And as such, you've got a lot of employers out there looking for people to fill jobs in that space.
Yeah, I think whereas 10 years ago, if you were so inclined, if you were technically inclined and interested in computers, perhaps you would have said, I want to be a coder. It's a lot more, because that could mean anything. A data analyst, which is my little area, we code, but we do it in statistical software. So I'm not exactly writing stuff from scratch. But I can sort of relate, and I'm on these various boards of other data analysts, and yes, all the interest is in AI-related positions now. Many of them existed 10 years ago. They're just rebranding them as AI, I've noticed. So the type of analysis we like to do in financial economics, does this cause that? Is this related to that? How do stocks behave when the Fed does this, GDP is that, unemployment is here, and inflation is there? Parsing the data to disentangle cause and effect and identify relationships that are useful to investors is what we spend a lot of time doing. And I notice they now call this stuff, which 5 years ago was called machine learning. We've sort of blown past machine learning. You don't see that phrase as much, which is just a fancy way of saying statistical analysis, frankly. And now they're all AI-related jobs. So some of this, I think, is just relabeling analyst jobs
to make them sound sexier and bump the pay up a little bit to get talented people in the door.
That again, more theater. There's a lot of stories, the theme of which is theater today.
That certainly is the case. It'll be interesting to see how that industry continues to evolve and what job growth that we see on the AI
We better
side.
see some. God knows it's priced into equities. So people seem to be banking on that and the Fed easing this year.
Those two things are really significantly important when you look at valuations, what we talked about earlier in the segment. Taking a quick look around at markets, we've still got all of the major indices in negative territory, with the NASDAQ being off over 1.5% and the Dow Jones off over 250 points at the moment. The NASDAQ is also, the S&P rather, also down.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
There are many ways to protect your assets from the nursing home. If you use a life estate, that can create problems, including the possibility of losing control over your estate. Call Cushing & Dolan today at 866-848-5699 and get their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699. Or request it online from their website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated.
Everyone has financial goals, and regardless of what yours are, the process of establishing a comprehensive financial plan is key to achieving them. This is Chuck Zada from the Armstrong Advisory Group, and our new guide called Building a Financial Plan may help. Some goals are bigger than others, like saving for retirement, but even smaller goals like paying off your credit card debt can be an important part of a well-rounded financial plan. As you build your plan, break your goals down into realistic tasks, establish a savings strategy, or determine an asset allocation that aligns with your risk tolerance. It's also important to create checkpoints to help you monitor your progress and make sure your plan remains on track. Call us today at 800-393-4001 and ask for our new guide called Building a Financial Plan. That's 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about the use of life estates and your primary residence. Todd, what are the pitfalls associated with creating a life estate when you transfer the remainder interest to your children?
Yeah, this is the most common way people create life estates. It seems easy, it seems simple, but it's not the best way to create a life estate. Once you put your children's name on the deed, you give up a lot of control. Like you can't change your mind later if you want to leave it to one child versus another who might be taking care of you later. You have problems if you want to go to sell it, right? You might have the right to live there, but if you want to go to sell it, you're going to need the permission of the children in order to sign off on the remainder interest of the deed. And then even if they do sell it and you get their permission, a larger chunk of the proceeds are going to end up in the hands of the child rather than you. That creates adverse income tax consequences to the child. Plus, you who sold the house might need the money to buy another house or a downsized house or move, all of which create problems. Never mind creditor problems for the children while they're living. Folks, don't do the life estate this way because it seems to create more trouble than it's worth.
Learn how you can avoid probate, eliminate estate taxes, keep your money in your family, and protect your assets from the nursing home. Request this brand new guide from Cushing & Dolan. It's called Calculating the Consequences of a Life Estate. Call 866-848-5699. That's 866-848-5699. Or you can simply request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Trivia question today was, what is the name of Penn Jillette's magic partner? Teller. Obviously Teller. Penn and Teller officially launched their partnership in 1981 with a Broadway show called Penn and Teller. Before becoming a professional magician, Teller was a high school Latin teacher. Winner today of the Financial Exchange Show t-shirt was Tom from Situate, Mass. Tom's also registered to win a $100 gift card to Applebee's, which we'll give away on Friday's show. And trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m. because half off is just more fun. Now, that's eating good in the neighborhood, void where prohibited, dine-in only.
So he couldn't get into clown college then. He had to teach, he taught Latin, tell her.
That's what it says here on this paper.
Oh, okay.
He was a Latin teacher.
News to me. America's apartment buildings are getting bigger and taller. We have seen that in the residential market, there has been really limited supply for single-family housing units out there. However, on the rental apartment side of things, there's been a significant increase in construction, particularly with larger apartment buildings that have over 200 units. In fact, that we saw 2,900 buildings with more than 200 apartment units be added to U.S. cities between 2021 and 2023, 17% more than what we saw from 2018 to 2020. There continues to be a significant amount of demand in the multifamily space. Now, rents have normalized a little bit. We haven't seen as significant as an increase over the course of the last year or so. In prior years, there was a significant uptick, but the focus on a lot of these developers is taking a smaller parcel of land, building higher up, and building more units to offset an increase in construction costs, which have really surged over the last couple of years as inflation has impacted every sort of sector of business out there. And Mark, from a renter side of things, it is perhaps a little bit more advantageous to be a renter now because in some areas of the country, not here really in the Northeast, but there is starting to be a little bit more of a glut of apartments out there, which can lead to more favorable terms for those who are looking to continue to rent in some of these popular areas like Austin, Texas, Nashville, Dallas. Some of these areas have been really built up significantly on the apartment side of things.
Multifamily, as you kind of alluded to, has been on a tear. So that's more supply.
Yep.
And it's not surprising that they're building units, building multifamily structures taller. There's less land to do it on, so you make the most out of what you're zoned with. So yeah, I would expect that to affect rents. I'm not optimistic that will. You see a lot of researchers and commentators, commentators say, well, this is baked into the cake. We've got a lot of multifamily supply coming onto the market. Inflation is going to come down. Since I always bring things back to inflation and the Fed, why not do it here as well? It may be true that rents come down, say, over the next 3 to 5 years. That doesn't mean inflation, of course, will come down. That is just one component, albeit a large one, of the price indices we use to calculate changes in inflation. Said differently, other things could be going up.
It's surprising to me that we haven't seen those shelter costs come through in inflation reports. A lot of the private data has pointed to the fact that rents have come down, but we haven't seen it. And I know there's supposed to be a lag, but I'm getting to the point where when is the lag going to show up in the data?
Yeah, I don't know enough about the calculation of that particular component of the CPI.
It just continues to surprise me because that was a lot that was baked into the cake on this idea of cutting rates this year, is that we were going to see some disinflation be provided from shelter, and we just haven't seen that just yet.
Yeah, we should know better than to look at one component of the price index, say this is likely to come down, and you could know that with certainty. You could have inside knowledge, or you could be interpreting widely available information, like the multi-sector boom that should put downward pressure on rents. If rents fall, CPI should fall. It absolutely does not. That last statement absolutely does not follow from the previous statement. Rents are one. They're a big component, but they're only one component of the CPI. You have to look at what's happening in aggregate.
Is there anything better than sitting on a beautiful beach, watching the sunset with an ice-cold drink? Well, you can experience that right now by booking your next vacation in the United States Virgin Islands. St. Croix, St. Thomas, and St. John are all unique in their own special way, and if you head to visitusvi.com, you can create the vacation of a lifetime. Whether it's the rich history of St. Croix, the pristine beaches of St. Thomas, or the spectacular nature of St. John, the USVI has a little bit of everything for today's traveler. Upon arrival, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Whether it's a romantic getaway or a family vacation, the U.S. Virgin Islands has everything you need to enjoy the vacation of a lifetime. America's Caribbean Paradise is waiting for you, so head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
An interesting piece here in the New York Times where Gusto and Stanford, two economists, used some payroll provider data from Gusto's company to determine that people now live about twice as far, if not more, from their office than they did pre-pandemic. They saw that the average distance for people's homes and workplaces rose to 27 miles in 2023 from 10 miles in 2019, so more than doubling there. They also saw the share of people who live 50 miles or more from their work increase sevenfold during the pandemic. Obviously, significant contribution of remote work here in this data, people living further away from where their workplace is.
It appears to be a persistent trend.
I did think that it perhaps would be a little bit more short-lived. I've always wondered aloud in the show that if the power came back sort of in the employer's court, or the ball came back in the employer's court where we had a weaker labor market, that maybe some of the remote work would subside if we didn't have 3.5% unemployment.
That's to be seen.
We certainly haven't got there yet, but I've just wondered if that would change things a bit. But I was down in Florida last week, and I saw just a significant amount of construction in the area. And this doesn't point to anything that I know exactly on the real estate market, but more anecdotally, I thought about it that because of remote work, these areas like Florida, not only are they a haven because of the state income tax piece, but if those executives who are higher up in their business can work remotely more often, there's more demand for people to be down there. I just think that goes across the sector in general. There's just more remote work, so you see more people being a little bit more flexible on where they want to live or where they want to spend their time.
For certain roles, if you're an individual contributor, which I sort of am, so I can relate. I take advantage of the remote time that we offer where we work. But I'm in the office every day. I think some FaceTime interaction is important. For junior folks who need to be mentored and to learn how to work. It's absolutely critical to allow them meaningful remote time is probably to their detriment in the longer term. You really have to get acclimated to the culture of workplaces generally and the cultural particulars of your workplace. And you have to just, again, learn how to work in a corporate environment. So for certain types of workers, individual contributors, maybe older ones, it's probably fine. But for many, it's going to hinder their career development.
I would agree with you that particularly when you're younger in your career, that FaceTime, that interaction on a day-to-day basis can really help develop rapport with significant leadership people in your company. And just being sitting remote in a junior role, it's harder to develop that over Zoom calls or Skype Messenger or whatever you use, teamwork messaging. It's more difficult.
Yeah, I mean, if you're hiring, and suppose you are hiring an individual contributor, a coder like we were talking about earlier, a very talented coder, and the choice ultimately came down to somebody who was willing to move close, so they'd be in the office 3, maybe even 4 or 5 days a week, versus somebody who was remote. All else equal, you'd probably choose the person that you could have FaceTime with, literal FaceTime, not Apple FaceTime, more often, right? All else equal. You want the person who's closer and more available.
Availability is still a very critical piece of some jobs out there. Others, they can be done remotely. But
yeah, and I worry about you. I wonder if younger workers, not worry, I don't really lose sleep over this, but do they think that this is sort of normal? I still feel a little bit weird about remote time, and I think that's probably healthy to know that your employer, Mike Armstrong was supposed to be here today. He couldn't be here today. So I'm here today. I may not have come in otherwise. I don't have any meetings. I don't think, and I'm not holding myself up as a model employee. I'm simply saying I would expect that of somebody that I worked for. So I wouldn't be surprised if other employers didn't start to put the screws to people and say, well, you should at least be available, or I would prefer someone who I could get their butt into the office if I needed them.
I do think with some younger cousins who've graduated from college more recently than I have, there is a little bit of entitlement built in on the remote work because it's what they've entered the labor force with, versus you and I have entered in different periods of time, me coming off the heels of the Great Recession in kind of the late 2010s, where you didn't have as much employee leverage as you do now.
It was a formative experience for you.
It was kind of you were lucky to have the gig, so the idea of asking for remote work when you're at the bottom of the pecking order, it was, kind of
I think that's
foreign.
actually a really good insight. You think about the Great Depression generation. These people used to dry out paper towels, and they didn't waste anything. At some point, you didn't have to. It probably looked a little bit silly, but that's the furnace you were sort of forged in, and those are the habits you developed.
We're going to take a break here on the Financial Exchange, but when we come back, we're going to be doing a little bit of stack roulette. That's right after this.
Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network. Life estates are not simple documents and can create the potential for you to lose control of your estate. Cushing & Dolan are experts in elder law and have nearly 40 years of experience helping families with their estate planning. And their new guide, called Calculating the Consequences of Life Estates, can help you make the right decisions about how to protect your assets from probate and the nursing home. Life estates carry a higher risk of income tax penalties and hidden gift issues, and while they can be beneficial in some cases, if you use one, you need to be aware of the pitfalls they may cause. If you haven't done your planning yet, now's the time to learn about the effects that life estates can have when it comes to protecting your assets. Call Cushing & Dolan today at 866-848-5699 and request their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699. Or request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Is there anything better than sitting on a beautiful beach, watching the sunset with an ice-cold drink? You can experience that right now by booking your next vacation to the United States Virgin Islands. St. Croix, St. Thomas, and St. John are all unique in their own special way. And if you head to usvi.com, you can create the vacation of a lifetime. Whether it's the rich history of St. Croix, the pristine beaches of St. Thomas, or the spectacular nature of St. John, the USVI has a little bit of everything for today's traveler. Upon arrival, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, no passport required, and travel from New England could not be easier. Make your plans now by going to usvi.com. Whether it's a romantic getaway or a family vacation, the U.S. Virgin Islands has everything you need to enjoy. The vacation of paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
With the stock market remaining volatile, it couldn't be more important to have a sound financial plan. I'm Mike Armstrong from the Armstrong Advisory Group. There are risks with any investment strategy, and that's why we've written a brand new guide to help you understand those risks and how they can be associated with any financial decision. It's called Building a Financial Plan, and it may help you recognize the potential risks and rewards that are associated with your investment strategy, in addition to offering insight into how to research making the decisions that are best suited for you and your family. The guide also provides information on how to establish clear financial goals and what steps might be needed in order to achieve them. Call us today at 800-393-4001 and ask for your free guide today. That number again is 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
There are many ways to protect your assets from the nursing home. If you use a life estate, that can create problems, including the possibility of losing control over your estate. Call Cushing & Dolan today at 866-848-5699 and get their new guide called Calculating the Consequences of Life Estates. That's 866-848-5699. Or request it online from their website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. There's only one show that follows Wall Street's continued volatility. Keep it here all morning long on the Financial Exchange Radio Network.
All of us at the Financial Exchange are truly thankful for our partnership with the Disabled American Veterans Department of Massachusetts. You can help our great American heroes too by making a donation today. Your gifts can support the Veteran Advancement Program, which offers permanent and affordable housing opportunities for veterans and their dependents. Learn more at dav5k.boston. The DAV 5K Boston is presented by Veterans Development Corporation.
All right, it's time for a little bit of stack roulette. Mark, do you want to bat lead off here?
Yeah, sure. Not the usual light fare, but I found this interesting. The title of the...
You never go.
Yeah, I always preface it by saying, gee, sorry, guys. I looked for something light, but I was drawn to all this dark stuff. I don't know why. Please forgive me. From the Wall Street Journal, patients, it's not funny. Patients lose access to weight loss drugs as employers stop coverage. And the upshot here, I think we all know that these drugs like Wegovy and others, I don't even know if I'm pronouncing that correctly, but these are miracle drugs for folks, and to this point they've been largely covered. So you have very modest, I guess, copays or deductibles, whatever the right term is for buying a prescription. Anyhow, increasingly to keep overall costs down, which is understandable. That's what they do. Insurance companies are imposing spending caps, resulting in patients paying the rest, and that could be up to $1,000 a month, up from virtually nothing. So look at the terms of your plan, I guess, if you are, if you're prescribed, I guess not just a weight loss drug, but any drug, they can change.
Yeah, interesting to note on the heels of that, Novo Nordisk is down about 3% today, and Eli Lilly also down their stock about 3% today as well. Those are the two companies behind some of the most popular weight loss drugs out there. So having a little bit of impact on those stocks today during trading here. America is swimming in sauce. This is a article from the Wall Street Journal where we have just reached a level where it seems like everyone and their brother is trying to come out with a new sauce, and the sauce market is so fragmented. You have Pepsi releasing a Pepsi Cola ketchup. I'm not even pronouncing it. Cola chup. That's easy to say. Popeyes went for a truffle sauce. We've had Jack in the Box working on a munchie sauce with a Michelin star chef, and Kraft Heinz has been trying to innovate in the sauce game for a long time now to develop other options outside of their most notably known Heinz ketchup. But at some point, it gets to just having too many options out there.
Think about your own fridges.
I was starting to think about
mine. I have 6 options, maybe 7.
Of condiments or sauces.
I put them in the sauce category. Like,
Okay.
I put ranch in the sauce category. I'm not a ranch guy. That's my wife.
Right.
But I have my homemade barbecue sauce. I have another barbecue
one.
sauce, James River. I have a Frank's Wing hot sauce.
We have a hot sauce,
ketchup
too.
I put in the sauce category.
Yep.
Yeah.
We have all of those. A couple different mustard types as well. Dijon, spicy, and honey, all in the Lane fridge. I'm trying to think of some
Honey?
others. Honey mustard.
Oh,
yes.
honey mustard.
Honey
Okay.
mustard. Those 3 types of mustard in there.
I was like, that honey's not a sauce.
No, not honey mustard, not honey
Gotcha,
standalone.
gotcha.
Soy sauces are in there.
Soy
as
sauce,
well.
yep, I got that one.
It gets crowded.
Does that go bad? Because that's the type of thing you see lingering
No.
for a long time.
I have had one for a very long time, and I've wondered that myself. My wife is a huge freak on locking in on the date of expiration or date of sale on there. I tend to operate on the wild side and sort of let it continue to go on some things. You know, milk is not something to be messed with. But,
No, obviously, yeah.
But something like soy sauce, I don't really scrutinize the date of sale on there. I just kind of continue along with it. Maybe to my detriment, but I'm still standing on my own 2 feet, hanging in there. You seem like someone, Mark, that would maybe scrutinize
Check the expert. Are you kidding? Yeah, I live for that. People bring me in just to do that.
What's the go-to?
That's the only reason I'm invited to things.
What's
hey,
the-
can you go through our fridge and check the dates? That ought to take them like 2 hours.
She goes absolutely crazy. My wife goes crazy with my mother-in-law, who is the biggest offender, particularly on a summer home. It seems like some of those sauces can linger around way too long, and there isn't a proper clean-out done. What's the go-to sauce in the Fandetti household?
I use ketchup more than anything, I think.
Ketchup is the I
Nothing-
mean,
nothing
obviously
fancy.
that's the standard.
No hot sauce?
No, I don't think my tolerance for it is. It's an
'Cause
acquired taste.
I've had fridges where I have 3 or 4 different hot sauces. Not even a barbecue sauce, hot sauce.
I have, like Mark, a very low tolerance for any type of
But I think
hot
we could
sauce
build it up
over time. But
I'm
I
just
just
not-
am not willing to commit to the work that goes into
I
that.
still can't find the original sriracha, by the way. Are you a siracha guy?
My wife is.
Okay.
Big sriracha
Have
fan.
you located this? Because it's
No.
been over a year for me.
No,
I'm talking about the green cap ball.
Oh, actually, I might have to circle back with you on that. We may have the answer to your problem. That I believe that's in our fridge, unless it's a
Okay,
rip-off.
I'm not talking about the rip-offs. I'm talking
Okay,
about
it's
the original one with the green cap. Can't find it anywhere.
We have one with the green cap, but it's probably a rip-off. But
Yeah,
I'll have
let me know.
I'll do some research on it here.
I know there was a red pepper shortage, which we've covered extensively on the show, but it's been over a year in terms of finding the original sriracha. So, anybody, let me know.
Text us at 617-362-1385 to solve Tucker's conundrum there. Fox is announcing that there's going to be a new sports streaming service launching this fall. It's going to cost around $50 a month. The biggest question here is what sports are going to be offered on this platform. What we do know is that the NFL is not going to be offered on it. Those ones broadcast by CBS and others, some of those programs will not be on the service. Murdoch, the CEO, predicts is that they'll have 5 million subscribers within 5 years of launch. It's just getting exhausting, guys, keeping up with the amount of streaming services and subscriptions out there. I just feel like we're heading for probably there's going to be consolidation at one point, but we're going to reach a point where we're probably already at it right now. It's too difficult to find the things that you're looking for, and I'm sure we'll reach a point where everything gets bundled back again like cable. But when you talk to someone about a good show to watch, there's always that hesitancy of, oh, what platform is it on? Do I have my parents' login for that? Do I have a login for that? How am I going to be able to see this thing? And it just drives me a little crazy.
If the NFL's not going to be in the sports streaming thing, they shouldn't even move forward with it.
$50. If
nobody's
you
going to
don't have
subscribe
NFL,
to this.
You're out of luck. That's all the time that we have for this episode of the Financial Exchange, but we'll be right back with you tomorrow morning at 10 a.m. Thanks so much for joining us.